welcome to another episode of the market updates. I just wanted to show you about the first quarter GDP, which is the January to March. The expectation, there has been a decline to 1.5%. Initially, it was also predicted as at only a 1.4, so there's actually a 0.1% downward revision. So it's actually a decline. So as I think we have mentioned before, if there are two consecutive quarters of recession, lower quarterly declines, it actually means that we are in a recession. It looks like we are in the middle. Of course, there are still many academics thinking that we are going towards a recession. I think we are already in it. And then the pullback in the gross domestic products represent the worst quarter since the pandemic scare Q2 of 2020. So there's also a pullback in the in this GDP, and our jobless claim has increased. So there are a couple of things that to show the U.S. economic contraction for the year. So first quarter gross domestic product declined at 1.5% annual pace, according to the second estimates from the Bureau of Economics analysts. This was worse than the 1.3 Dow Jones estimates and the write-down from the initially reported 1.4. So I'll send this link over to you so that you can have a better picture. So the US government revised downwards on Thursday the country's economic contraction for the January to March period by 0.1%. So there's been quite a bit of the things happening on Thursday and Friday. Of course, you got the CPE data that I mentioned earlier, and then you got the Fed's meeting minutes about them intending to raise the rates and all that for another two consecutive 0.5% basis point, and they may pull back. So just wanted to show you that what are the indicators. So basically, you can look at things like the jobless reports. Of course, if one of the indicator of recession is a jobless report collapse, meaning there's a lot of people becoming jobless. And of course, the second indicator, as I mentioned earlier, the GDP growth decline 2 consecutive quarters. And of course, there are other indicators as well, like by this Meet Kevin YouTuber looking at Google search trends. And even, some people are using this very interesting indicator that says, stripper says a recession is guaranteed because the strip clubs are suddenly empty. So consumer demand has actually dropped. Of course, fifth indicator you can look at is probably the credit risk, which is also very default risk. Maybe at this present moment in time is insulated to the crypto crash, especially the Luna coins. Especially people pledge homes to buy those stable coins, thinking that they can have a net earning of interest. If they get a 20% interest versus what they pay 5%, to the bank, to their mortgage. And another probably 6th indicator is looking at this bear market right now that's happening for the 7-8 consecutive weeks of decline in the stocks, means that's bear market. We can see Meet Kevin YouTuber as well. He did mention that it's 50-50. Sometimes it goes, so it's not really related. And then these are all important in the sense that they are intertwined with Fed's being dovish or hawkish, because they wanted to create a soft landing and not crash the market, but they don't mind for the market to correct in a major way. So if inflation has dropped and recession has already we are going through recession, so consumer demand has declined as well, this may create may cause the Fed to actually slow down in the hike in the interest rates, because too high interest rates will create a bad inflation, which is companies may not actually take on too much capital investment, which is needed right now in US, because as globalization starts to break down and everything becomes more circular, people want their own, all the supply chain to be within their own country. So I believe that the Fed will not increase the interest rate too much, and they would allow people to take loans to build factories and all that in Austin, Texas, or whatever, So another thing is about the oil and gas, energy, as well as the food. I believe the government is working behind the scene, as US is really rich in resources, to start fracking. As you can see, Warren Buffett buying Occidental and Chevron big time, two big US big energy companies. And I believe that they will be the great big beneficiary of the market in providing oil to the world, especially Europe continent, that are less and less reliant on the Russia oil. So I just want to show you other important things about Fed. At last adopted appropriate policy posture. Some say former Treasury Chief is right to emphasize flexibility. Yeah, this was actually in line with what was mentioned on Thursday, that they said, they chart the path 2 times of 0.5%, and after that they might go flexible, or they, as they are still probably quietly believe that interest rates, inflation may be transitory. And of course, now with still a strong consumer demand, there's a lot of revenge traveling right now, so consumer demand in the service sector is definitely surging. So you might see that probably dampen a bit after second quarter, and things become more stabilized, both in the consumer products, which already slowed down, and then as well as the consumer services, to kind of like back to where it was pre-pandemic. And that would be a more stable way of predicting future future consumer behaviors. So I just mentioned before just now, the working definition of recession is 2 consecutive quarters of negative economic growth as measured by a country's GDP. So yeah, so I did mention about that. And other things that you probably need to take note would be, let me see. First quarter contraction revised down. I think I mentioned that before already. It's pretty much, you can check out the link which I will send to you. So what else? I think one second. So okay, I just wanted to give you a couple of very interesting point, especially particularly one which is at 12 minutes. 1 second. Whereby he did mention that
probably aligned it more like this.
The bear market means that we are in a recession. So it's not actually.
Fox, Rivian, and Disney. That's my going. But let's put it this way. Bear markets never historically have occurred since before a recession started. So in other words, if you're in a recession, the bear market happens while you're already in a recession. So if we're in a recession, and that's why we're in a bear market, there you go. This is the bear market recession. However, there have been a lot of false alarms. In 1987, 1966, 1962, the S.Ep fell more than 20% without an imminent recession. And stocks fell slightly less, but still dramatically, less than 20%, but still dramatically, during the recessions. And these are the actual recessions of the early 90s, the early 60s, and early 50s, but we didn't actually go down below 20%. So even though that 20% number is kind of like, okay, why that?
Yeah, so yeah, you can see that it's actually not all the time that a bear market is actually an indicator of a recession. So there's a lot of false alarm. So I'll show you this very interesting point as well, which I think is not really relevant, but it's funny.
Lows a little bit after those searches, and right there, that the number of mentions of bottom nailed the bottom of the COVID dip.
Based on the number of
If you
bottoms.
look sort of roughly into the pre-election pain period that we had over here, you kind of saw retail a little early here. Look at that. If you align that, you kind of saw retail a little early on that one. We really kind of hit our lows a little bit after those searches and right before the election when we had peak fear here. This right here was potentially, in my opinion, I'm going to call it hope. And I think retail missed here. This was in the February crash. Remember when in like February of 2021, we had this sudden like U-turn by Jerome Powell and he was getting more hawkish and markets started falling? There you go. Retail didn't, really, it's hard to say that retail kind of nailed it there because we don't have that alignment there. And same thing is true over here. And this is where it's like, it's not a perfect chart. We fell a lot. And the more we fall, the more people are searching for the word bottom, right? So really out of these, I kind of give this more of like a coin toss of being accurate. But I'll tell you, this one, pretty dang strong in terms of a signal that when you get like a really big, massive hit, maybe that.
Yeah, so basically, I think based on Google Trends, it's actually in a way relevant. It's like what Warren Buffett did mention before. If you see your wet market seller or fishmonger starts to buy shares, that means you know that the market is overheated and it's about time to sell. And you should be and when if everyone is actually talking about market bottom means that it's greatest fear. So that could probably give a hint to us that it's probably time to buy. So now if you look at Google search trend, it's actually a little bit on the high side right now, but of course not as high as the COVID period. But even strippers it's probably if you are talking about buying the dip, this could probably be it. So thanks for watching, and hope you find this entertaining as well, and please like and subscribe to the video. Thank you very much.